Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Go to focuscompounding.com to get access to free investment write-ups from Geoff. If you're watching the screen right now, we have content going all the way back to 2005. If you're a frequent listener of the podcast, you've heard the pitch many times. Go to focuscompounding.com just to get access to everything that we're doing. Our podcast backlog is there. If you want to learn more about our money management services, because we do manage capital, you could get access to that under the Invest With Us tab. And of course, if you want to stay up to date on things that we push out into the world, the best way to do that is by following me on Twitter at Focus Compound. All the information is in the description down below. So be able to do that. Just click that description and you'll get everything that you would want to get more access to everything that is focused compounding. So today's date, Geoff, is December 27th. This is the last podcast of 2022. And, we're going to take a little bit of a different spin here today and really just kind of make it a podcast about reflection from the year 2022. If it takes 20 minutes, great. If it takes 20 hours, RIP to me to have to edit that, but also great. So before we jump into it, Geoff, given that this is the last podcast of the year, how was the holidays for you? How was Christmas? People want to hear how Geoff Gannon's Christmas was.
Christmas was good. It was cold.
Was Santa Claus good to Geoff?
Yes, it was good. I got good things.
There you go. It was cold. That is correct. Mm-hmm. So I guess it does get cold in Texas.
Yes, it was a freak weather event across a lot of the United States. So yeah, I had some busted pipes and no bathrooms and things, similar to what happened in early 2021.
Are you kidding me?
No, I'm not kidding you. But I have more than one bathroom now. Before I lived in an apartment with one bathroom, and that went on for 2 weeks, so that was harder. I had to stay in a hotel that time. This time, my house still functioned well enough, and after a few days, it was fine. Yeah.
Oh my goodness!
Mm-hmm.
I was going to ask you if you, being, the responsible homeowner that you are, I was going to ask you if you covered up the outdoor faucets, that
yes.
maybe have a hose attached to it.
Mm-hmm.
I put a couple towels on it and then I put a plastic bag over it. So you still did that.
Yes.
And your pipes burst. Are you kidding me?
No, so pipes not inside the house burst. So what happened was a system that I never use is that the place that I live was originally built to have a golf course that they never built and everything, and it was supposed to be an HOA and it never happened and whatever. So because of that, they had put in a lot of irrigation stuff, right? And so a lot of the houses hooked up to like this irrigation system thing. So although I never use it and it is insulated with just like a bag, the pipe outside for the outside water burst. So but the bathrooms thing was fixed in like a day or two. It was just because it gets down to I think we had it was like 10 degrees or something, but with the wind chill it got down to like -10, -15 or something, and that's unprotected, that particular thing. So I'll put something up to block the wind better. So it was stuff that was exposed to wind that had it, but
crazy, absolutely crazy. So today is December 27th, as I had said, and I thought this was interesting to re-bring up this Barron's cover, the infamous Barron's cover that has actually become pretty famous as they were mocking Warren Buffett. That is Barron's, what was published on December 27th, 1999, an article which was the cover that is titled, "What's Wrong, Warren?" And it was an article that was basically talking about how this old washed up guy that likes to drink Coca-Cola and chew Wrigley's chewing gum was out of touch with the market and this new way of investing that is investing in these high growth, high tech internet stocks was the new regime, and that Buffett was washed up. So I thought it would be funny to bring it up because it's interesting, the saying that history usually is not the same, but it often rhymes. Do you think we kind of went through that the past couple of years, with Buffett?
Yeah, I mean, before and during COVID, I think that when he gave his very negative kind of talk at the annual meeting, I think there was a lot of talk of that sort of thing, that he was being too pessimistic and, that he had sold some stock and not bought stock, in the COVID panic and all of that. Sure. Same sort of thing, because the market was, at that point, let's see, the market was basically actually starting to already go up by the time of that annual meeting. So I think that time is the closest. Yeah.
Yeah. That was when he was basically saying the phone isn't ringing off the hook.
Right.
And he was talking about people in the depression, didn't know they were in a depression until a few years later. He was sitting there all by himself in the auditorium and just doing the annual meeting without Munger next to him.
Correct. Yeah.
Do you remember this Barron's cover?
I remember things on CNBC and all of that at this time. I think we talked a little bit about this. When I was getting involved in investing, the first few years, the perception of Warren Buffett was very, very different than it is and has been for the last 20 years. So he went through different periods. And if you watch specials and things from the earlier 90s, in which he was seen as, being around the time of, he became super famous probably around the time of like what was the book that what was the first one? Not the Warren Buffett Portfolio, but the other one. That one was
The Warren Buffett Way?
Warren Buffett Way, thank you. That was like a huge best-selling kind of thing. Investing books aren't normally like that, and so that was really big. And he had done, there had been Solomon, there had been the Cap Cities and all that. So that's sort of like, until Cap Cities is not that famous with the general public, Cap Cities taking over ABC. And so for about 10 years or something, they are capped off by the publication of that book. He was just this, like, that was the Oracle of Omaha kind of thing. And you can see interviews from that time that kind of treat him more that way. That it's about him being that he's not in New York. How does he do this? And he's a big investor in media things and all of that. In the late 90s, he was already super famous, right? Because of that. And so then it was, how is that the most successful investor ever? So not successful when everyone is making money, right? It's kind of like the meme stock thing. People who just started investing were making huge amounts of money, sometimes huge returns, sometimes a lot bigger than the investment managers were making. It's kind of like when we talked about some different mutual funds, where I said, if a mutual fund goes up 100% in a year, because they're pretty diversified, it's not likely that, those don't usually end well, right? And that's the kind of thing that was happening in people's personal portfolios, with IPOs. But Buffett doesn't do IPOs, and that whole IPO thing was sort of rigged in those days, especially to make sure there was a big pop on the initial day. It was really from about the time of the Netscape IPO on is when I kind of think of the .com bubble, sort of in the sense of whatever prices were, the mania with it going on with just individual investors and all of that coming into it in a big way. And IPOs, especially, being a really big thing that you were supposed to get in on and everything. And, this is the era of like Jim Cramer and momentum stocks and things like that. Those are the kinds of things that people were writing articles and all of that. And Barron's is actually, of the major publications, one of the more contrarian, more value-oriented, really, than of any of them, probably.
Why do you think these manias continue to happen? Do you think the professionals that are involved in the mania, that, market the mania, that quote unquote pump the mania, do you think they understand the game that they're playing? It just seems like stuff like this always comes up every few years in financial markets.
Yeah. It's a combination of different interests for each of the groups doing it, right? What's wrong, Warren, whether that's a good article or not, in terms of how it's remembered, probably gets interest, right? It gets talked about, people read about it. So tearing down or a big famous figure, using the name of a famous figure, then doing it in a surprising way and stuff like that, works for the media. So the media focuses on those things. So I don't think they're necessarily interested in pumping up a mania or not, but I think they're okay with pumping up FTX, and they're also okay with covering the downfall and stuff. I mean, they're just doing it for the entertainment value, for the news value of it, of selling things and clicks and stuff. So that's the media's interest in it. Other people's interest in it is what gets flows. And so when we talk about like investment managers, the problem that they have is even ones that were successful value investors in the last years of the 90s, their funds shrank even when they were actually getting pretty good returns. Because a couple things were happening. One, relative returns were sometimes poor for some of them, right? So that hurts you. But a lot of them weren't down until the very end of the mania. And then two, the flows were even more extreme than the returns, right? So people were chasing returns and stuff, but even more extreme than that, they were pushing into the tech stuff and away from other things that were working pretty well. So that's a really big part of it. I mean, it's a thing when we talk about ARK innovation and all that, even if it's down a lot over time, sometimes it still has a surprisingly high AUM, right? Compared to other things which have exactly, which would have a similar track record over a certain period of time or something. So having a lot of publicity, a lot of notoriety, whether it's positive or negative, just getting you a lot of press does help with getting a lot of assets. And that's how you make the money. And especially then, because we're not talking about hedge funds and stuff. We're talking about people who are making money on the management fees, and more so than that, even for the people bringing them the money and everything, and for the organizations that are backing them. It's more about even just bringing in the money in the first place, right? That's more what the business was like back then. So like Third Avenue, like Third Avenue Value and things like that. Those sorts of what was it, First Eagle, those things. That kind of stuff is the thing that has like really bad problems at this time, in terms of just like, no matter what your performance is like, you can't get your fund is shrinking and you're in trouble.
It's interesting when you talk about Buffett and like his level of fame. I mean, if you watch the Becoming Warren Buffett movie, and especially like the outtakes when all of his kids sat down and had a Q&A for a few hours that is available on YouTube, I believe all of his children had said that, when they were growing up, his father was not a famous guy, certainly, compared to the present. And you had just mentioned that as well. I mean, for people that maybe weren't focusing on investing in, the late 90s, or maybe for somebody that was born in 1996 or thereabout, would you say, like, would you compare his level of fame back in the late 90s to like, maybe like somebody like Munger today, where if you're in the industry, you're very familiar with who he is, but if you're outside of the industry, maybe you're not as familiar, or maybe these other hedge fund managers like Ackman, who again, in the industry you're familiar, maybe some other people because, he does more activist stuff or whatever, but like outside of the industry, you're not as familiar. How would you compare it?
But this is, early days of the internet. So the internet was not a source for news and for getting people famous and everything. So a lot of niche stuff didn't get that much coverage. It's through broadcast networks and things like that. So a few people were very famous, and Buffett, once that book was written and everything, was definitely very famous with the general public. He'd already been very well known by investment people, and was really well known by people who knew media things, right? So I mean, business people knew who he was, especially in publishing and media and broadcasting, all that kind of stuff. And so it talked about that way. But I think the book changed everything. And but there also was a much bigger aspect to it of the simplicity of it, and that he was in Omaha and all that. Because remember, everything that we have now about the biography stuff, really, what is American Capitalist? When's it published? Like mid-90s, 96, 95, I don't remember but it runs through about that time. So that kind
1995.
of 1995. Okay. So that, and that's not as big as like the Warren Buffett way or anything like that. But I just mean all of our information about his background, his biography and stuff is all from that and from the Snowball. Right.
Mm-hmm.
So it really was about, and when was Warren Buffett way published?
1994.
Okay. So yeah, but that's kind of, I would say, the height of his fame in terms or the height of adulation of everyone being, that Buffett's the greatest and stuff, was from, let's say, 1994 to, 3 or 4 years later, maybe 4 years later, when the .com boom is in enough of a period. His record through, even as the stock record and stuff, through and for Berkshire through 96, 97, to about the time of the Gen Re deal or something. From the Gen Re deal on, I think, is only when there's more negative press about it usually. So I mean, his record was still, his stock investing record was amazing in the 80s and 90s, and so was it for the first half of the 90s, and it was that way for Berkshire stock too. So yeah, but that's kind of, I think, before those books came out and stuff. So let's say before the mid 90s, he's much less well-known person. Yeah.
So obviously you've studied Buffett for the majority of your investing career. Not only that, but you've also been learning in public, investing in public. You've spoken with hundreds or thousands of investors over the years. So I'm just curious, when you have somebody like Buffett, where he's been in, the public, or there's a ton of information on the way that he invests, the way that he thinks, you have the Buffett FAQ, you have all of the annual meeting archived videos. Why don't more people emulate the way that he invests? And I know there's a famous quote, which I can't verify, that Jeff Bezos basically asked him the same thing. And Buffett's answer was, because nobody wants to get rich slowly. So I'm kind of curious to hear your take on that. What is it? Is it like the whole nature versus nurture thing? Is it a personality thing? Is it the difference of personalities, right? Monish Pabrai has said that Munger is the type of person that always needs to be doing something, where Buffett isn't that type of individual. I mean, what is it from your point of view?
Yeah, I think a lot of that is true. Buffett is unique in that he structured things from very early on so that he wasn't like other professional investment managers. I think there's a reason why Peter Lynch, who we can see up there, quit so quickly. It got too big, and he was too much of a traditional professional money manager that way, just to be a giant mutual fund. The kind of life that he was living and that Buffett lives, of maniacal sort of just absolute focus on what he's doing through all those years of investing, is something that people, unless you've read those biographies, probably don't appreciate. That he probably spent all day reading for stuff, investing material, and then came home and read a bunch and was probably thinking about it at all times and everything. Peter Lynch was probably visiting companies and talking to companies and things all the time. That was, they don't have, working hours and stuff like that, and a separation between their life outside of work and their work. Their work is their life. And that's, kind of the thing that they're growing like a snowball over that entire period. So, I mean, when he ran the partnership, he didn't tell them what they're invested in. So people overlook that, but not knowing what you're invested in makes it much easier if you have a really honest person like Warren Buffett doing it, as for better results. And the other thing is that a few aspects of how someone invests often get blown out of proportion in people's minds and become sort of like catchphrases or something of what they imagine them to be like. So it becomes like a cartoon thing, right? So like Peter Lynch, if you asked the general public at the time that he was most famous, or the general investing public, I should say, people who would, of that time would be the people who would watch like Wall Street Week or something, right? With Rukeyser, that's the closest to like the people who would listen to our podcasts and things like that, right? That was about the extent of it back then. So those kinds of people who were kind of fans of finance stuff, right? At least would have said, he says, buy what you know, buy what you like, right? Like if you eat at McDonald's, buy those things, right? And he owns like 2,000 stocks or something. He owns everything, a little bit of everything, right? Those are the only things that they know. And he manages like a giant fund and has an incredible record. But that's it. If you read the books and everything, he talks about how he really made the returns and what misconceptions people had and everything. It's very different. And Warren Buffett, I think, is the same way, where I think there are certain misconceptions of his record. And especially from the time of like the 90s and the Warren Buffett way and everything, it becomes this really big misconception that he sort of just like buys Coke or something like that, right? That became like the investment that everyone talked about, that was, how he made all his money was from that sort of thing. And
do you think he talks about that reason the most just because it's something that everybody could understand on a very basic level?
Maybe. I'm not sure that he does talk about it the most. It gets written up by the most, talked about the most. But if you listen to his annual meetings, if you listen to his interviews and stuff, I think he says some pretty intelligent things that don't get picked up as much in the press about what he's doing. He talked plenty about arbitrage. People didn't talk about how to arbitrage like Warren Buffett, but he wrote about it extensively in his shareholder letters. He talked a lot about accounting things and how they might hide stuff and how it could look better than it was or worse than it was. He talked about inflation and all that. I think that gets picked up with Coca-Cola and all those things about how to beat inflation. But there was a lot of that I don't think gets covered as much. And then also the way that the compounding works, having a very high rate of compounding for a fairly long period of time early on, especially if it's consistent, has a really big effect on the record over the full period of time. So people do underestimate how important the record is when looking at the early days, the period covered in Capital Allocation, the book, right? For Berkshire and also for Buffett's own wealth, how much of it was driven by how long he performed well with a fund, because he had a fund for about the same sort of time that Peter Lynch's career was running a fund, and Buffett's was a hedge fund, and really small, but that was a really important part of it. And only in the last few years did it have meaningful investments that were at all like the investments he made in other that he become famous for later, with the American Express and Disney and those sorts of things. So I think sometimes, any of these things, they sort of gets focused on a few things that they said or whatever. If I said Pabrai or something, everyone would say, heads I win, tails I don't lose too much or whatever,
Yeah.
So there's
exclamation point.
Yeah. And so certain ones they just are remembered as activists or raiders or whatever. And part of their career, they may have made a lot of money from that. Part of their career, they may have made money from a different way. You kind of have to read the biographies and kind of work it out to figure out how they really did in things. There was a period where everyone was saying he was getting these special deals and stuff, and he got a lot of negative press for that at the time of the preferred stock deals and all of that. That happened a little bit after the financial crisis, people saying the same thing, but it happened a lot then when he couldn't find things to invest in. And you had some negative comments from people about the different preferred stock deals that he did with Solomon and Champion and US Air, which were, a very mixed bag. And then, Gillette and American Express, which he could have just invested in directly and gotten really good results. So, just invest the way that other investors would in the common stock in the open market. So, and it, like people were saying that as if that's where his record came from, but his record didn't come from any sort of special deals like that at all. In fact, the special deals sort of stuff wasn't particularly good returns and not a great use of money compared to other things that he did. But like he's explained what his record was in arbitrage. He gave an estimate of what it was, going back in the records and looking at it and figuring out what it was on levered and everything. Well, that's a really good record. If he did that his whole career, he would have a record that would beat the vast majority of investment managers, and would be a pretty good thing for an investment bank to have someone running that kind of business for them. So he's upfront about that. It just not as talked about and as famous.
Why do you think that is?
Well, one, as we know from doing this podcast, the allure of the 100-bagger, the buying and holding forever and making a lot of money on a single stock. Here's the day you buy it and then you hold it. This is how much you would have made in this one stock from this one idea, and anyone could have seen it, is really, really big, right? So there are some people who will talk to me about nets or arbitrage things or whatever, but that's not ever going to be as exciting to people as other ways of investing. So I think that is part of it. And then the other thing is, you have to kind of create a consistent picture of the person when you're covering them in the media and stuff. So you kind of get rid of a bunch of things and you focus only on those few things. And so there was always played up a lot of things about his background in Omaha and stuff, and some of that stuff is silly, right? Like the corn-fed capitalists and all that. We've been to Omaha. Omaha's a city. He grew up in a city. His dad in politics and stuff. He grew up in Washington D.C. too, also big city that way. He went to school in New York and worked in New York with some of the best known people in Wall Street at the time, and frequently visited there all the time. And obviously went to school originally at one of the better business schools in the country, and very much connected to all sorts of people there other than Columbia. I mean, if you think about it, where he went for all the schools that he went to, although he went to Nebraska then, where anyone would go for those sorts of things. So playing up the thing about Nebraska is a thing because of how the news coverage, right? So the people covering him in the news are either from New York, Washington D.C., or L.A., right? Those people are talking to him and covering him. So their image of what Nebraska is, or what that upbringing that he had or whatever, I think is pretty different from the reality. So he did not spend any time on a farm. He doesn't know anything about farming. Not a person who would be in a rural area ever. So but that becomes part of it, even if that's not really true.
I mean, my perception of Omaha, and I'm from the Midwest, right? I'm from a town that is basically just cornfields, rural area. My perception of Omaha is it's almost like the field of dreams in real life. I mean, it really is surrounded by cornfields, and then you have a very pretty, clean, small-ish city that is just seems like it's like the field of dreams, just like in the middle of a cornfield. But I do understand the whole I think it's like fun for people, or it's appealing to people. If you're a reporter reporting on it, it kind of is clickbaity in a way. I mean, even we talked about this headline, right? Like, what's wrong, Warren? That's a very clickbaity article or title to an article where you're just going to basically trash him and get a lot of clicks, or I guess in this case, views.
Yeah. So the period that you're talking about, though, that is what I remember is mainly coverage of that kind of thing, that his record was so good. How is it that it's not good right now? Yeah. And so, but that's mainly what I remember him being talked about and stuff, is someone who might be past his time, older, and all of that. In fact, there was more focus on his age and everything then. So
yeah, it's interesting. I mean, it's like that old quote about like 99% of his net worth has come after his 50th birthday. And here he is, turning 70 in 2000, the article says. And it just shows really like how long he's been doing this. And most people probably would have hopped off the train a long time ago, especially if you're worth, I don't know, a few $100 million or $500 million by the time you're 50 years old. That's probably the thing about Buffett that is so different from other people, is just he has kept at it for so many decades.
Yeah, and I think the big thing about that is how he kind of did that from the start, how he organized things so that he could do that without a point where he'd have to kind of retire and stuff. I mean, he closed up the fund. He didn't necessarily think that he was going to be investing other people's money all the time. And there were some points in which maybe he wouldn't have been doing that. I don't know that he, if he had a background that was more, if he had taken over Graham Newman, when Graham left, I don't think he'd still be investing today and all of that. We wouldn't know about him the same way, or, he would have had a much shorter career. So I think that's a really big part of it too, is the way that he did it, how individually he did it, so that he could do it for the long run. But that's something, that we know from the biographies, how much of kind of an obsession of that is of him, how much he disliked discontinuity, and so he'd like to set up vehicles and things that in theory could just keep going on, without having an endpoint in mind for that, and that's harder when if you're running an open-end mutual fund or something, that was never going to happen.
Yeah, absolutely. So we could hit on the market as we come into the last few days of 2022. S&P 500 looks like we're going to end up somewhere around down 20% year to date. 10-year yield at 3.86%. Crude oil around $80, and natural gas $5.80. $0.18. And, as we review the year, I was thinking, Geoff, what will I remember 2022 the most for, right? How I remember 2022 the most. And, I really am going to, in my head, kind of think about it as being like the death of speculation. So gone are the days of $1 million JPEGs selling. Gone are the days, I'm probably familiar with this, but everybody listening is, of like the fire eyes on Twitter and the NFTs as the profile pictures. Gone are the days of the SPACs. Gone are the days of the meme stocks, right? AMC, I was looking today, down 85% year to date. Not only that, but we've talked about a lot on this podcast how much they diluted the company through COVID as well. GameStop down 53% year to date. I'll remember Facebook, or what was Facebook before they changed their name to Meta, down 65% year to date. I think that was actually the top in Meta. I remember obviously the Russian and Ukraine war and the sanctions that were put on Russia. I remember inflation hitting a 40-year high of 9.1% in July. And then, of course, the rate hikes that have come with those hot inflation prints to try to tame the beast and put the genie back in the bottle. I'll remember U.S. mortgage rates going above 7% for the first time in 20 years. And then I will remember Elon Musk buying Twitter. And I'm kind of curious, Geoff, to hear, I know I just rattled off a bunch of really the highlights, but I do think there's been a paradigm shift. And I'm curious to hear what your thoughts are as to how you will remember 2022.
Well, in terms of the general stuff, that's happening, not anything specific to our business and investing that way in our stuff, but just in general. I think I remember the S&P 500 down 20%. The increase in short-term interest rates, the speed of it, and money supply growth, deposits and things like that going to basically negative, if not completely flat. Those things rarely ever happen, right? There's not a lot of calendar years down 20% in the S&P. Most people are not used to seeing money supply growth of nothing or negative, and no one's ever seen, with the exception of a few. Well, from levels that were low, no one's ever seen short-term rates rise this fast. They've risen this fast if they were already extremely high for a brief period, but basically no one's ever seen it going from very low rates to high ones, So, yeah. But basically to me, it's just like, the tightening of financial conditions, the move from completely loose to tight. And that's a lot of what you're talking about with the manias and speculations and all that is, things are quoted in money. So, if you're, growing it by a lot, that's having an effect on everything, whether it's real estate, stocks, different weird collectible things and made up tokens and whatever. But anything that you say, this is in some sense scarce, you can't print this isn't money. And then, we can see what happens if money didn't grow. If money didn't grow from year to year, what was out there, those things wouldn't be happening, and it would feel like a completely different world. So, yeah.
More on, excess being taken out of the market, liquidity being taken out of the market, long dated securities coming back down to earth. I'm curious. I mean, so here we are. We could talk about everyone's favorite stock to, talk about these sort of things, and that's Tesla. It's down 11% today. We are around $100 a share. It's currently trading at $109 per share. I don't know what it's doing since it's closed. Is this a margin call happening right now in, real time?
Well, I don't think that there's literally much margin and stuff. I don't think that's having much of any effect on anything. I think that, we can go to QuickFS to look at some of these things, but I've talked before that the easiest way to tell speculation, or if there's unusual amounts of speculation stuff, is by comparing things that give you an immediate yield or a yield that's calculable to things that you can't price. And what happens is that when you have two things that should, in theory, be very similar, two assets or something, or two things that would give you cash flows over time that you're trying to value, come up with intrinsic value for, if one of them goes to the moon and it's one that's very hard to value, and one that has a more steady value to it in terms of the flows off of it, or in terms of some book value number or whatever, that's kind of what speculation is. And the divergence of Tesla versus other automakers is extremely indicative of speculation, of too high a level of speculation, and is consistent with the idea that there was a lot of money and a lot of credit creation and stuff like that, a lot of wealth effects that people are feeling for the last 5 years or so, right? There was some parts where it changed and then came back in a big way, but basically that it got to crazy levels in that. And Tesla, after huge declines like this, the rest of the worldwide auto industry all put together, maybe on an enterprise value basis, depending on how you calculate it, might be a bit bigger than Tesla. On a market value basis, I don't think it is, depending on where exactly we are today and everything. So Tesla had to fall more than 50% to get to levels that are basically all the other, in theory, you could buy all the other automakers for. And we see that in a lot of different ones where you compare two stocks in the same industry. Even when we talk about things like movie theaters, right? Cinemark always made more money than AMC, even though AMC is the biggest. And, still is valued at lower than AMC, I believe, even though, its history of the last 10 years, whatever, has more, operating profit and stuff. So that's to some extent because one of those seems like it's being valued as volatile as it is and stuff as a stock, right? Cinemark. And, Marcus and any other theaters and stuff. And AMC is a special category of stock, right? It's not really a stock anymore, or it wasn't a stock. No one's looking at that. And even analysts are saying we can't use price targets and things that base it on the actual business. We have to guess about all this other stuff. So those kinds of things, right? And that's a lot of what you see, right, with Tesla. But you've also seen with a bunch of other stocks, and people try to come up with individual explanations for it. Disney, I think Disney will have its worst year, right, in since 74 probably. Around that time was really bad for Disney, the 73, 74 period, so I don't remember exactly how much it was down, but that would have been the last kind of catastrophic collapse in the stock price.
Any other come to mind?
Well, most of the media things are down a lot. What's Netflix? What's happened with Netflix in the last year? What's happened with Meta, which is,
yeah, the whole FANG crew has basically gone whopped.
Yeah. And take tech, for instance, and what tech means. We think of Netflix and these things as being tech. IBM is flat or up for the year or something. And it's actually more of a tech company than any of these companies, right? But what that means is something else. It's not a growth company. It's not, a big hot stock or anything like that. So we mean something else when we say tech. Obviously IBM is more of a tech company than Tesla or Netflix. We've redefined what that means, and it is in each period redefined as what kind of hot stocks of that period are. And that's usually what we mean when we say tech and growth and all of that stuff, is not just that it grows a lot or that it actually has technology things, but that it's in this category that we're talking about the speculative aspect to it, that they're going to make a lot of money in the future, new ways of doing things, different business models, that kind of stuff.
Got it. So we recorded 43 podcasts in 2022. Now, to be fair, we did shift from doing a few a week to doing one long pod a week. So I'm kind of curious, Geoff, to hear if any podcasts for you stick out. And really, what are your favorite podcasts that we do? Is it when we do Q&As? Is it when we just look at stocks the whole time? Is it when we just talk generally about things? What are your favorite type of episodes that we record?
Well, I don't listen to them again, usually. That would be very rare, and doing it just for the purpose of getting some information in for something. So I think I listened to the last one from last year, I said, to get a feel for what we talked about at the end of last year, because otherwise I wouldn't have an idea of what we were actually saying back then and how much things have changed, right? your memory won't serve you right that way. So with the new format and stuff, no, I don't remember particular episodes that well. The things that I like best doing are the ones where I feel like we're talking about some really useful idea or deconstructing something in a way that presents it in a new way to people that I think they can take and use. And so like when we talked about confidence things, I don't know if we did the best job with that or whatever. That was the plan to do that. It wasn't the plan to do that because we don't plan ahead for that. Yeah. But that kind of thing, if we can get that idea through, if I could express that idea well, would be really useful, because it's one thing that I say all the time, that this kind of investor Buffett is. And I think a lot of misperceptions about him are that way, that they don't come from a place of understanding how he thinks about probabilities and high confidence in things. And why would he buy this Activision thing as an arbitrage, and why would he do this, and all of that. So talking about ideas like that, I think are really good. The podcasts we've done in the past, free cash flow plus growth, what it takes to be 100-bagger, things like that. And then, or the ones that we did, with the talking about, the different parts of capital allocation, particular investments that people made and stuff like that. So things to try to bring something new or different way of thinking about it for people. And then actually bringing useful ideas, interesting ideas. And this is dangerous because when I say this, I just mean that this stock is interesting. I don't mean you should go out and buy this, which I want to make that distinction clear. But there's something interesting going on here. Pay attention to this. Study it for yourself or something, because we have some people who are active investors and will really dig into these things themselves, and they may, if it wasn't for this podcast, I don't know if they would be aware of Alico or something, right? And so that could, who knows, but that stock could keep going down, things could keep happening, whatever. It could be a situation that otherwise they wouldn't be thinking about or looking at or whatever. So those kinds of things are the ones. So bringing ideas of less covered stocks or stocks people wouldn't be looking at, not even less covered, but just like you might not be thinking about this or not talking about it. And it's an interesting situation. The arbitrage ones, even though I know that's not a favorite of people's, saying, look, here's Hunter Douglas and what the situation might be in that. Here's Cambria, here's Activision, here's whatever, Twitter, which went through. And just talking about that in real time to people, and then they can go back and listen and, or remember that, they lost money on this deal, or this deal worked out this way and why and everything. Instead of like, what I don't want to do is here's the formula for how you do arbitrage or something, which is what everyone puts up on YouTube or on websites or whatever, is like, take like Ben Graham's formula or something, and here's how you're supposed to plug it in, or here's how you're supposed to do a DCF or something. Instead, take a real situation and show you the good parts and bad parts and what are the risks and the opportunities that there might be in it of how things could work out. Because like a lot of times when I talk to people, it's funny because I'll talk a lot about something like, if they know we own some stock or something, they'll be like, oh, it sounds like you're much more pessimistic on it. Like you don't like it as much and stuff. And I say, no, this is how I talk about stocks. I mean, if we own something, I think it's going to go up a ton. When we talked about the FICO thing, I said, look, I would have thought it was going to be higher. I mean, the FICO went up 20 times in 10 years or something. But some of the things I would have predicted on the day I bought it turned out to be wrong. It underperformed some of those things. And so you have to be realistic about what things you would have expected, what really happened. And I think that's useful to do that. So I definitely like talking about specific things, stocks that I think are interesting for people to look at and to think seriously about trying to figure out, right? And especially if it directs them to find things on their own and really study stocks that aren't being as that aren't such a superficial coverage or something like that. I mean, as much as we could talk about, Disney things or whatever, it will turn into being a talk about the overall industry of the different things that it's in, right? Because it's a big thing that's exposed to all of that. So I feel like whenever we talk about any of those things, of course it goes into those stuff, right? And the same thing when we talk about banks or something, people ask like, well, what about the future of it with the fintech things? Maybe they'll ask about that less now because some of those things are down a little bit more stocks, but well, this is future proof and stuff of the future. And to me, that's not like, and they asked that about the car dealers too, right? We talk about like Virtu or something, those aren't the biggest issues that actually face those companies as stocks of whether the stock will perform or not. Like the fact that interest rates were going up so fast since whatever, and the match of the liabilities and the assets, and you try to point people to that kind of thing, because I think about banking even until the second half of this year. Most questions were more about like the future of it and like how I'm, well, but I use PayPal and stuff. And so how do these really work? And there are these things that send me stuff asking, saying you can get a mortgage loan and whatever, so how does this banking stuff work and how will it work in the future if we're all using these, new things, buy now, pay later and all that stuff. Will there be anything left for banking that way? As opposed to like, the difference that it makes if you're able to borrow and stuff overnight at like nothing versus having to pay 4% or something, which is huge. So I like to get into those specific things. And we've done ones with specific banks or whatever, where we try to like take that apart of what things matter and, quick FS things. Yeah. So.
Yeah. And maybe we could do more of that in the new year, especially because in past episodes or past, times when we would go over some of these things, if we were trying to keep to like 30 or 40 minutes, perhaps maybe we like rushed through it.
Right.
And not only that, but like the energy that would go into, I don't know if this so much is like on your end, I'm just speaking for myself, but like the energy of like recording 3 episodes, I think to keep the energy up, it's just honestly easier to do like one intro, one outro and just one show, even if it's 2 hours, opposed to if we just did, 3 podcasts when we record, we batch record, and then I upload, slice, cut, whatever, upload 3 different episodes. I feel like it's just much more like, I don't know, easier to produce a good show if you're going to do one longer format. So, perhaps we could revisit things like that in the new year, just because we are recording longer. And I mean, just so I understand too, right? Like we've spoken about on the podcast, the whole Six Flags situation.
Right.
That's a situation in the public markets right now. That's a very interesting thing that I don't know if a lot of people are paying attention to, that you would direct people to pay attention to. That doesn't mean we're buying the stock. That doesn't mean we own it or anything like that. But it's just a good lesson or learning situation that's currently going on in the market.
Right, absolutely. And that, even though that's a very heavily traded stock, and I'm sure hedge funds and whatever things buy and sell it all the time and whatever, like we were talking about with Hanes Brands, I don't know that like a lot of people listening to the podcast would necessarily be thinking a lot about Six Flags. They might even not be thinking a lot about something like Hanes Brands, even though we showed that that's an insanely a huge turnover, and that's or even when we talk about Cinemark, which again is like, it's not a huge stock or something. These are all, mid-sized sort of things, but they trade huge amounts of volume and everything. You could get in and out of them instantly. And so they should be well understood and well looked at and stuff. But, there's probably plenty of people who haven't looked at them before. Yeah. So even those sorts of things I like to do. And I would also like to do more things, I guess, where maybe even if we talk about things that are bigger stocks or whatever, but are more representative of the kinds of things that I would tell people to look at, right? These are the kinds of businesses that, when we talked about the confidence thing and everything, these are the kinds of businesses that Buffett would look at, that I would look at or whatever, if you were restricted into that size thing. So I'm saying Buffett because, he has to invest in huge, huge stocks. But, I'm not going to buy a stock that is, a $20 billion market cap or $120 billion market cap. But there are some of them that are a lot more predictable and whatever than others, right? And so sometimes it just sounds like I'm saying, well, I don't like Micron or something, but that's not what I mean. What I mean is that there's a very big difference between that and, well, like here, like Taiwan Semiconductor, right? Which is TSMC, probably the ticker or something like that. Maybe it is. Let's see. Well,
let's see. Pumps up through here. TSM. Got it. TSM.
Okay. Yeah, TSM. So here's a stock that, presumably Buffett bought. We don't know that. Berkshire bought it in the last, recently, based on the size of the company and the size of the buy and the time that it is and the company that it is. I don't know enough about, Weschler and Combs to know like specifically if they would buy something like this, but it totally seems like the kind of thing that Buffett would buy. So this is the kind of thing in which you might have high confidence and stuff if you understood the business. It's not a business that I understand well. It has some possible geopolitical risk, although, to the extent it has geopolitical risk, that means that the world has it. because, obviously if it completely ended the supply for a company like this, then, the world is in short supply of stuff. But it's a company that you can see that has margins and the gross margins and the operating margins, which you can see here, and all of that are very high but very, very stable. Like when I talk about, especially when you talk about something like I talk about the coefficient of variation or something, because these margins are so high, gross profit margin near 50%, sometimes operating profit near 40%, sometimes. The fact that they're varying by so little in absolute terms means that on a relative basis, they're varying by even less than that. And so that's something that I've always stressed that way. And actually, if you look at the pure numbers here, the thing that you probably will stand out or might stand out to you, something that the thing that stands out to me if I didn't see the name of this company, right, is the railroads. It looks exactly like a railroad. Now, it doesn't look like
it does not look like a semiconductor.
Right. It doesn't look like a railroad in terms of the asset growth and the revenue and stuff today. But what it looks so much like in terms of the gross profit level, the operating profit level, the spread between them, and the very slow turns. So you'll see here, for instance, you can immediately see that the 10-year median margin for like pre-tax income is 40%, and yet the return on invested capital is about half of that. So the turns have to be really, really slow for that to be happening. You can also see that in that the free cash flow is half of the pre-tax numbers that we see there. So what that means, again, is that you're reinvesting huge amounts, right? And so the actual level of returns is fairly low. It looks to me like this is a business that maybe returns 20% a year. And it's not all in cash and stuff right away as it's growing, so who knows? But that creates a lot of value. Someone like Buffett looks at that and says, okay, 15 or 20%, even 15% you can live with. If you're growing at high rates, is doing pretty well. And what we talked about in terms of that, the Todd Combs idea of those three criteria that we talked about, right? P of 13 or less, right? Well, look here.
Yeah. Buffett's was 15 or less.
15 or less.
Said
sorry,
your spin was
13.
But you said your spin was 13 or less. That's
right.
how you
is. They're saying 15, what is at 15 basically. Mm-hmm. And so looking forward a year, whatever, you'd say, because if it's a forward number, this thing's at 12, at 13 going back, trailing now. So going forward, 15 for a growing company over time sounds very possible. The 10-year number in terms of revenue is 15%. How many years have they grown less than, like, say, 7% or something, which is Buffett's the kind of target they talked about?
Mm-hmm. So, I mean, when you use that framework, Geoff, I mean, is that the type of framework that would ever put up Buffett 1.0 type numbers, or is that more so the Buffett that has to deploy so much capital where he can't find those more off the bean path type of investments? I mean, are you going to put up high double-digit numbers following that framework? I mean, if you're paying 15 times PE for a company, it's growing 7%. A lot of that kind of sounds like the market to me.
Yeah. This is not American Express when he bought it in the 60s, or Washington Post when he bought it in the 70s, or See's Candy, right? It's also not Mid-Continent Tab Car Company. It's a lot like all of those except for a few. Most of the things we're talking about are actually fine. The price is fine that way. The growth levels are fine and stuff. There's a few problems here. One, the company's too large. Two, it doesn't turn its capital as fast as those other things. And three, the margins aren't going to improve the way that those did. So, but it could be if you discovered Taiwan Semiconductor in 2002 or something. Like, this company was a lot smaller 20 years ago. So actually, I don't know what the returns in the stock have been for 20 years because the price could have been really high or something, 20 years ago. But it's not that far from, but yeah, it is the kind of company that could give you really great returns for 20 years probably if you had discovered back then. It's too big now, obviously, to do that for you. Just because in terms of like the world size of it, and also because it's probably in things that, although I know that I'm sure there's people who have amazing expectations that this will grow faster in the future than it's been in the past and stuff, it's probably a sector that will grow slower in the future than in the past, just because of how much saturation there is in terms of stuff as the one was before. So that's a period of incredible growth for the industry, but it's the kind of thing that probably Buffett would look at or whatever. And yeah, actually all of those are fine. Like in terms of having high returns, you might be surprised. The issues that I see as a potential problem here is primarily margin and free cash flow, particularly is being generating it in cash terms, right? So if the 10-year median free cash flow margin is like 20% and you're turning like half, then your actual ability to generate free cash flow in terms of relative to your equity is not that high. So you're basically getting, if it was at a price to book of 1, let's say, it's at 4.5. But if it's a price to book of 1, you'd really only be generating, if you're using no borrowed money, you'd really only be generating about a 10% or so return in cash each year that you could buy back your stock, pay a dividend, whatever. And then the other 10% or so has to go of the cash that you have. That would have to go into reinvestment. Now I'm saying it as like 10 and 20, which might be confusing, but why I'm saying 10 and 20 on a margin basis, it's 20% free cash flow margin and 20% margin that you're reinvesting, right? But on a turn basis, so relative to your capital, it's actually going to be less than that, because that's something people need to keep in mind. So it looks really, really good, though, in the same way as like a railroad, in that it has sort of maximum efficiency. What it seems to be looking like, if you didn't know anything about the business, is it has the maximum level of scale possible, which would make doing this business on a smaller scale nearly impossible. And Apple actually has a lot of similarities to this too. Apple's a much better business, although I'm sure it'll grow less in the future, or I would assume it will grow less in the future. But this is a company that doesn't even have like 50% margins quite on average, and yet is able to have free cash flow margins of like 20% and pre-tax operating margins of like 40%. We talked about things like Six Flags and all those. So those sorts of things, entertainment things that are like that, like theme parks and stuff, cruise ships, whatever. We're talking about levels in which your gross profit margin is usually about 90% or something, not 50%. And so it's all based on having very, very high operating expenses that you have there, right? And that's how you're able to do it. But surviving on more narrow gross profit margins is usually a like safer way to be protected against competition. Obviously, narrow gross margins while having very high profitability is really attractive. It's something I always warn about, that you want a high gross profit margin, because the thing is, with a business like this, if I was looking at it in the early days, right, the big warning sign would be, this is a really, really tough business in which anyone who doesn't get enough scale may not be able to earn much money. The upside, though, is that if you get a lot of scale, it may be so difficult for other people to fund themselves with it that they'll exit the business because the gross margins aren't high enough. That's where we talk about, like, economists and stuff talk about the minimum, the minimum necessary scale that you need for it. So the minimum scale at which you can be efficient and stuff. But I talk about it as like a habitable zone, right? Like, can this business exist and stay in business and keep funding itself and stay as a competitor, right? The problem that you have is, like, say, a restaurant or something. A really small restaurant can do exactly that. One successful location, it can do that. And so, like, there's no way to ever eliminate all the competition, no matter how efficient you get. But a business like this, you can see that there's probably a pretty serious problem if you try to operate at much lower scale, right? Because the leader with tremendous scale actually doesn't even have those amazing gross profits, right? They have amazing profits overall. And actually they're, like we said, return on equity and all that, it's really good. But what is it, like a Costco type return on equity or something? Railroads use debt, so the actual return on invested capital of railroad will be less, but I would expect the return on in the owner's money return might even be better at a railroad than at Taiwan Semiconductor. But so it's just, that's the kind of business that Buffett would, I think, be interested in, probably because he would understand it from Apple, but also because he understands some things like Nebraska Furniture Mart, Costco, the railroads that I think he likes, and is comfortable enough with some sort of things about scale advantages and stuff that he doesn't necessarily talk as much about. But he has talked about, survival of the fattest and all that kind of stuff. He would prefer, See's Candies, right? You'd prefer the really high gross margin, no need for capital and all of that. But if you have to buy $300 billion companies, then this kind of thing would make sense. And I don't know that he bought this. It could be someone else, but it has all the marks of Buffett just in terms of the price, the growth levels. I mean, on a quantitative basis, it looks like Buffett in every way, right?
Totally. And even like the price to earnings, right? I mean, this is sort of, if you look at, for people who want to learn, I mean, this is a perfect snapshot of a company that he would be interested in, even by just like Geoff laid out, the variability of the margins, the stability of the margins, the price that he's paying from a PE perspective. This looks entirely like Buffett.
Correct. The problem is the first two words, Taiwan and semiconductor, is what would make people think, no way, that's Buffett, right?
Yeah.
But he bought PetroChina, and people would say, oil, China? No, Buffett would never do that. But that PetroChina one, I think, was 100% his idea and everything. I don't think he discussed that with anybody. That's not like a BYD. That's like Munger's idea or something. There's no way that someone else came up with that one. So,
yeah, very interesting. Very interesting. Okay, let's go on to another point of reflection. What was your favorite experience or memory in 2022 in relation to focused compounding, capital management, and everything that we're doing? Personally, mine was probably Omaha, but I'm curious to hear yours.
Yeah, mine was Omaha.
And what did you like the most about it? And will we be there for 2023? I mean, it's crazy to think that that's, we have to start planning for these things. But I mean, right. Geoff, hotel rates go through the roof.
Yeah. It was a lot of fun. One, we saw some people in person, right, who listened to the podcast or something like that. So that is a nice benefit, as opposed to just you do this and put it out there, and who knows if 8 people are listening or 8,000 or whatever, right? And so, that's part of it, yeah. And for me, that was probably the best part of it, was that way. There were other things that were okay and odd and stuff, but got used to. Obviously, you're in this really strange situation where you're recognizing all these people and they're recognizing you and stuff. So people coming up to you and asking you, like, if you're Geoff Gannon and stuff, is weird, as you'd imagine. And we're there together too, so obviously people are going to recognize us, because it's a lot easier than if we were traveling with other people, and they might not see the exact 2 people that they see on YouTube and on stuff like that all the time. So, so it was pretty interesting that way, But so it was good talking to people, and it even in other things, we went out to dinner and stuff afterwards with some people and stuff, and that was interesting too. Just even because we don't normally get a chance to talk about whatever stuff, stocks and things, with lots of other people who do that. Yeah, I mean, as you'd imagine, we don't normally speak to like other portfolio managers on a regular basis and stuff, so that is something that only they understand and stuff, what you're talking about. So that is different too, and that was nice.
2023, will we be in attendance?
I don't know. Is that decided yet?
Well, we got to decide, but the people have been asking. Have been asking. I always thought it would be a good thing to make that a yearly thing.
Yeah.
Because it's like there's investors of ours that go there. There's people that listen to the podcast that go there, and it's kind of easy just to have it all be, 3 or 4 days, and just you're there in this setting, and it's fun, and it's kind of perfect for it.
Yeah. No.
Company just go there.
Yes, I'm for it, and I'm fine doing it. I feel like the people who organize and stuff for us in terms of the event that we did, probably gave a lot of free drinks to people and stuff that I don't know if it all converts into like business, or as much as like just meeting and listening to people and whatever. But it's great for us, and it's great for the people who go there, and it's a good experience. I don't know if that's like how that works exactly in terms of just because you have a lot of people listening to you and meeting you and all that kind of stuff, if that like is the the best way to bring in money and stuff. So but because like it's hard to get space and stuff there.
Yeah, very much so.
On that weekend, I'm sure you can get space in Omaha for other things, but yeah, if people have been there, I'm sure know that like everything is booked up, and you're seeing people and all the hotels and everything having events of all, I mean, different companies are having events that have booked up things, different money managers are doing it, and just all sorts of different things. Everyone's meeting and greeting and having their annual things and whatever. So it becomes like you're suddenly like, I know, in New York or whatever, trying to get space and stuff. So yeah, but I mean, they did a great job doing it for us. So
yeah, absolutely. But for anybody listening that maybe has been on the edge about going or not going, I think the both of us would totally recommend you should go, especially the two gentlemen that you probably want to go there for. That is Buffett and Munger. Given their age, you should definitely go. So follow the regret minimization framework and go, and you have a good time. And the best part about it is the people that you meet there. Right? It's just everybody's an investor there. Everybody.
Yeah. I was gonna say, I think go for that, but like spend time around it with all the other stuff around it is the part that's really good. Within a few blocks, you're gonna have all the different companies and people and whatever that you've ever wanted to see and talk to and all that. Even get together with a group of people to go or something who like that kind of stuff and are interested in. And you can just one hotel after another, one bar after another will just be filled with all these people that you've read their books or you've invested with them or you follow what they're invested in or whatever, and all sorts of things that people who do podcasts and stuff like we do are there and whatever. I mean, it's just, I think there's way, way more around that than people realize, right? That it's not just a bunch of people coming to Omaha for the annual meeting, see it, and then they they shop there, they see it, they leave. It's all the stuff around it makes it. It's like you're being at a multi-day trade show convention type atmosphere. The whole thing, yeah.
Absolutely. Okay, let's move on. The biggest winner. What would you consider to be the biggest winner in 2022? As it relates to either an investor or just markets in general? If you had to break down something and say, yeah, that was a winning thing as it relates to financial markets in 2022, what would you say?
Well, probably whatever AQR does, right? So it's so strategies that didn't work before with no volatility and interest rates at zero and all of that kind of stuff. The much more traditional, some of it's not so traditional as it's heavily quantitative, but the idea of a hedged fund, right? That stuff worked really, really well. Yeah. Not just didn't work well. It didn't just work well in one market or in one thing. It worked well all over everywhere. The kind of stuff that made money that we talk about making money through periods in the 60s and 70s and into the 80s at times, that did really well and had not done well for basically the last decade. So that kind of thing, which is more cheap, short term, and very value driven in terms of kind of provable values, and stuff that normally makes money all the time, makes small amounts of money all the time, right? That you can do in those things. So it's the equivalent of when we talk about in our world, the arbitrage and the nets and things like that. That's the stuff that did better, and not the big giant companies that are the quality companies, right? Like Quality didn't do that well, or things that are low quality and expensive did even worse actually, but even things that are high quality and expensive, right? I mean, now Tesla is considered a leader in what they do and has some of the best financial metrics in that, Disney's one of the better diversified entertainment companies. Netflix is the leader in and if you had a basket of those three, what are you went from having $1 million to 350,000 or whatever. I don't know the exact number, but something horrible like that. If you bought them on day one till today. So, but because they're all really expensive versus peers, really expensive versus, they're the things that I wouldn't short them. But if you had to predict, will this company do better than that company? They would be the ones that you'd benchmark against and stuff. I mean, Buffett just took higher endowments from colleges and said, I'll take, when he was in the later days of his hedge fund, I'll just want everything that you own. That's what I'm going to short. I'll take it all as a basket. I don't need to know what's in it and stuff. That's what worked this year. Right. And I mean, certainly for us and stuff, I would have, if we had been positioned that way, we had the portfolio that we had, plus we would be short out the expensive things. Well, then we look like we had a really good year compared to what we did. It's because on a relative basis versus the most expensive things, a lot of stuff worked well, right? So being in commodities versus stocks, right? Being in cash. I mean, if we saw what asset classes did the best, right? It's like gold, cash. As I said, if we're outside the U.S. and invested in stuff that benefit from dollar, but just in general, things that were not financial assets, right? So your bonds, your stocks did the worst, and the most expensive of those things, right? So like, what would be what? Well, I don't know how it did this year, but like as an example, going into the year, you would have expected what's like some of the most expensive bonds in the world. It's German government bonds, right? So they probably, I don't know what they did this year, but I bet they didn't do well. Even compared to other things that, so they're just the extreme overpricing of things, even though that might be perceived as some of the highest quality bonds there are out there, they are really expensive.
Mm-hmm. My answer, I mean, just to simplify it, I didn't think we would spend half the podcast talking about him, but it was just actually Warren Buffett, right? I hate to be a broken record about it, but Berkshire Hathaway is up 2% as we sit here and record right now. And just Buffett's investing in general, right? Like, again, it was just, I would give him sort of the king's hat for the year because his investment in Occidental Petroleum, I mean, Occidental is up like 100 something plus % on the year. I think it's one of the better performance stocks in the S&P 500. And, it was just a great example of when all the excess comes out of the market, that's when Buffett continues to march to the beat of his own drum and continues to shine. So if I were giving any sort of investor or anything financially related, sort of the winning trophy of the year, I would give it to Buffett. And I think it's just a great testament to why he's been doing this for as long as he has, and why some of these other investors that we speak about where, they have some crazy years and then they're out of the business 3 or 4 or 5 years later. This is just why Buffett is still around and why he's been around forever.
Yeah, and the thing that's really interesting that we haven't talked about in terms of what he actually did this year and stuff is I can't think of many managers who would do anything like this. In one way, it was very macro because basically he sold banks and bought oil. Now, like he bought a lot more oil than he sold banks because he didn't have all that much of the banks to sell down and stuff. But it's interesting what he did, and it's very macro driven that way. And it might not, each of these things on their biggest numbers don't seem to matter that much, in terms of Berkshire's overall portfolio, it doesn't look like he's doing that much, but he did that. And he did arbitrage, right? Too.
He's pretty active.
Yeah. And not just pretty active, but active in ways that he normally isn't. Right. Mm-hmm. So I think that is I don't know if he sees a sea change of the way that, we were talking about with Howard Marks, right? But he definitely took actions that would be more consistent with like this is 1974 or something than this is 2014, right? Because he had long been just holding on to a lot of financial things, and if anything, trimmed those things and eliminated them. Whether it seemed like for price reasons or something, he wouldn't necessarily do that. And he kept buying oil even as it was going up to some extent. He would buy when it came down a little bit. He wasn't always buying at the top, but he was buying even as it was going up that way, which is not normally his thing to do in terms of such a macro speculation. Big buys in Chevron and Occidental when you kind of add the two together, right? And even the Activision one is a large individual arbitrage position. He bought kind of the maximum that you'd probably be comfortable with having one investor in for an arbitrage thing. He might be willing to buy more for a company he plans to hold forever, but for a trade, that's probably the most percentage of the company he would ever buy. So it's kind of maxing it out that way.
Yeah, well said, and I agree. The biggest loser in 2022, if we're going to talk about the winner, well, we got to talk about the loser. So what would you give the biggest loser trophy in 2022 as it relates to investors or markets?
I mean, I don't want to say it because it's unfortunate. I think the biggest loser is probably individual investors, young self-directed investors, just based on what I know from, polls and things and what they say that they're invested in and in what ways. Most of the things we're talking about, these professional money managers and these big things and whatever, have an allocation to crypto stuff of 0. That's not the case for some of these others. They have an allocation to meme stocks of 0, right? Same thing here, right? And so they're probably, honestly, the ones that on a percentage basis and stuff did the worst. Yeah. I don't think, we talked about the .com thing. That was a period which was interesting in that some new retail investors who never invested in stocks before and stuff were doing way better than the market. this is probably a year where they did way worse.
I had FTX as my biggest L in 2022. And it's funny for everybody listening, when we got off our podcast last week, Geoff was like, I think we may be the only commentators, podcasters, whatever, involved in finance that have not brought up the whole FTX debacle. Yes. And you kind of have a variant view on it, which I'm not gonna, if you don't want to share, no worries, but I'll kind of share what you kind of said.
All right.
A lot of investors, Sequoia, people are like, oh, we're in the business of taking risk. It's not the investor's fault. I didn't even bring that up to you, but you just had come out and told me that you thought it was fascinating because you had thought it was so obvious that there was something weird going on with FTX.
Yeah.
And you said that you thought it had all of the hallmarks of being a situation where something weird could be going on.
Okay, so we could get real technical with this and stuff. It misses one hallmark of it, which is I've heard Sam Bankman-Fried, right, talk before in the past. Not a lot, because now people heard him way more talking things now than ever in the past. But transcripts of what he said to different people and interview things and whatever. And his personality in those public venues, for the most part, is not entirely consistent with a fraud from the beginning normally. So I've talked about this, about having, markers of things that are consistent with psychopathy and with just general tendency to deceive, take pleasure in deceiving others, a disconnect between being able to say things that aren't true and not bothering you that they aren't true, playing off of, you're seeing the other person's face, you're talking to them, you're selling to them, you're just a salesman without any sense of what you're selling. His personality, though strange, is not entirely consistent with that as much as some other people. So it's not the most obvious one. I think I said to you off the podcast, to me, it was not as obvious as Theranos, which was obvious, hearing 2 minutes about it. And that went on for a really long time. But it does have all the unfortunate markers of, if you were going to create a fraud, how would you create it? And all of that. It has all the things that would be key to doing that. And the actual behavior that he had that we knew about and stuff is also consistent with fraud stuff, involving people who have ties to you in other ways and stuff, putting them in charge of that stuff, separating yourself from it. That's a lot of things makes it easier to blame other people, right? For when a fraud happens, because it has that conspiracy aspect to it. That's always kind of the point that I make about fraud things, is that usually there is not a smoking gun, because it's a conspiracy, and you can't prove a conspiracy of any kind on that basis, because, if you're that's why RICO laws and stuff exist. If you're the head of the mafia or whatever, you don't have to put out a memo saying exactly who to kill, when, and why, and who should carry it out. You can express it through the way that your organization works and everything in different ways to carry out what you want to be done, with the actual actions being taken by people under you doing all that. So, but it had all the markings of that, obviously. Yeah. I mean, the big ones, like we said constantly, is, it's the exact opposite of what people say, which is, well, how could something that was endorsed by all these celebrities and had all these people, and, well, who would need that? Right? That, a fraud needs that. Why do you say that we're pushing for regulation, doing all these things, while you're actually in the Bahamas and who knows what you're doing, And we knew that. We knew all of that. So who does that? That's someone who wants to present themselves as complying with regulations and stuff, and then actually not doing it. Who needs
by their actions.
Yeah. We knew everything about the political donations. Who needs to do that? The SNL crisis, right? If you look at some of the really bad ones there, they were the most politically connected. That wasn't an accident. It wasn't like the politicians' fault that they were politically connected. The politicians would just take the money, but the reason they needed those connections and stuff, to be a protection for them, and in the sense of just giving a veneer of that, in public. And so a lot of times there was a presentation of this as being the cleanest sort of organization in a part of town that's probably full of a lot of not so clean organizations, right? That's kind of how they presented themselves. You understand that you're taking credible risks and there's a lot of dodgy stuff going on in this industry, and who knows, but we're the most trustworthy of those in it and everything. So, stadium naming rights, of course, is, there's Gillette and stuff, name stadiums, but it's not that kind of thing, political things, the celebrity things, all of that is, stuff that you're more likely to see with frauds. Now there's other stuff that's different in that they didn't do a thing where they had a board and filled it up with respectable people and all that, which is normally what you do. That's more the Theranos approach. And that's what I've talked about, that having, whenever anyone tells me, well, it can't be a fraud because it has all these amazing people on the board, usually it's more likely because it has a bunch of people who don't understand anything about accounting or business or whatever, but like won, peace prizes and served in government and are celebrities and stuff,
They didn't have a board, they didn't have a CFO, the weird related parties with his girlfriend that's running the hedge fund,
and
just a bunch of odd stuff.
You just ticked off a bunch of stuff that I've seen publicly traded companies that people think are not frauds that check those same boxes. Literally don't have a actual CFO, or the CFO is also someone else. The connection, like husband and wife or the girlfriend or whatever. And they're not really being a board or something. So, you do see it, and it doesn't mean in any of these cases that it is a fraud or that the point at which it started to be a fraud and stuff. And then they just had the huge opportunity for fraud here, which we've talked about mostly off the podcast because I don't like to talk about it because, I think Buffett said this, what point is there? I'm not going to dissuade anyone from investing in this stuff. And the people who are investing will, not listen to anything else that we have to say if we talk about it that way. But there's a lot of selling of stuff in crypto things that bother me. There's the things that get all the publicity, but then there's the little things that actually bother me the most about it that aren't as talked about in how they represent some things. And one that bothered me and it failed was the arbitrage thing. That, you kind of create this situation similar to SPACs where you kind of convince people they can't lose money and stuff on it because the way you set it up, you convince people this arbitrage thing will naturally work and stuff, which anyone who knows a lot of stuff about arbitrage things know that's actually not true, that you can't, that just because something should work that way, that the market could fail, and that in fact probably will. In a lot of ways, we talk about arbitrage things all the time, and given enough time and enough capital and stuff and willingness of people to do it, it'll work out. But, Buffett was willing to do a deal for long-term capital management, and he would have taken it, and all those arbitrage positions were worked out. Long-term capital management failed, though, because, their trades, which were correct, weren't going to work instantly. And also the backing with the reserves, nonsense that we've talked about. There's a lot of evidence, I think, that people are misled in the sense of that you have assets that in some way are similar to cash, and that's not true and probably hasn't been true at a lot of these places for a long time. And it's bad because to the public, it's like, well, yeah, banks do this and the same sort of thing, right? Like we have more reserves than banks or something. Yeah, but there's certain things that banks can own and certain things that they can't own. When you deposit money in a bank, it's a lot of it, banks, insurance companies, lots of these things, if you look at their balance sheet, can be turned into cash, will naturally turn into cash or can be turned into cash very quickly and under all sorts of different circumstances to pay you, the deposit holder or the policy holder, back. And if you just said, okay, well, a bank can go out and buy office buildings instead of, making loans or something and say, oh, it's 100% backed by property, they're not allowed to do that because you can't do that. You just not any asset. And in this case, sometimes these are made up tokens and things, but not any asset counts the same as any other asset. Right. Mm-hmm. Sometimes the talks we have after the podcast or something are probably more interesting than what gets on.
I know we got to do like an after dark podcast where we both get a drink and just sit there and talk. And we'll be banned from the industry after a few episodes.
Yeah, with that one, what's happening is I was complaining. The thing that I was complaining about is the media things and other people like that saying, how could you tell this was a fraud ahead of time? How could we be held responsible for talking about it this way? It had all the marks that it was okay and whatever. And that is the part that bothers me. People lose money on frauds and things that will happen. The venture capital things, look, it's not a big thing versus other ones they invest in. It may work out fine to take a flyer on some of these things and not do a lot of due diligence on that. But all the people who write the articles and stuff and then don't really say that we've been writing articles all the time that haven't gotten into all this, including basic things like, okay, where are you living right now? And what's the connection between this person? I mean, just like really basic stuff of making sure that you have it to put in the article. Yeah. So it's like the media in the sense of the specific media coverage of it that bothers me and stuff.
No, I'm with you. I mean, full transparency, because I don't spend time in this crypto world. I did not hear about SBF before 2022. I mean, I didn't know who this guy was. I mean, quite frankly, I think I had saw some pictures of him here and there, probably scrolling through Twitter, because I always, it's pretty easy to remember somebody that has like an afro or whatever.
Mm-hmm.
But I had never heard of him. And then I remember just the PR and the articles that were coming out about him as being like the crypto savior that has billions of dollars to invest in this downturn that's happening in the overall crypto market. And, and then, props to over the counter markets, the CEO Cromwell.
Oh, yeah.
He called them out because somebody laid out a pretty decent Twitter thread or a long Twitter thread this summer, basically saying why FTX should buy over the counter markets. And I think it was the president at the time. He said, oh, this is a very interesting thread, and FTX and Sam like the post. And then Cromwell comes out of nowhere and basically says FTX is not Lindy, OTCM is Lindy. We've been around for a long time. FTX has to, blah, 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 do whatever. But that was kind of my first okay, this is the SBF guy that I've been seeing everywhere with the afro that, sort of plays this old, folksy Warren Buffett character. My effective altruism gives money, blah, 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 so it was just weird to me, kind of like the whole, how'd you go bankrupt gradually and then suddenly. It was I heard about him for 20 minutes and
right.
within that 20 minutes, he was sort of this pariah. And now he is this individual that is probably going to spend 30 years in prison, I'm sure, at a minimum. I mean, if not more. So it's so wild to me. I don't know. I just don't get it. I don't understand why people take that route. And it's just weird. It literally is weird.
Yeah. I guess I'd only heard about it mostly because of the thing that really got it, I think, was this most recent election cycle, because it's all very public, what money you've given and who's the top donors. And so people who report on that, who may not know that much about finance things or any of this, will dig into it and be like, wait, what is this? How is this thing I've never heard of donating some of the most to a bunch of these, on a bunch of different lists for different party things and whatever, which is really unusual because it's a pretty boring list usually of people who have incredible amounts of money that you're used to seeing, and organizations that need to really lobby on certain things and stuff. And so that, I think, really stood out. And then the other thing, which is you see a lot, is any article is the same article. I mean, before this all went bad, is the same stuff. You could tick off exactly what things they're going to mention, right? They're going to mention who his parents were and what they did and stuff, and all of that, and the exact same thing that you said about the effective altruism thing and all that. So it's the same sort of, it feels like you're seeing the same article all the time, and not people who really either have access or whatever and are just kind of writing articles about it. Obviously, at some point, putting up his picture and his name and stuff got clicks, right? Because it just started appearing. I wasn't reading these articles and stuff, but it just started appearing as a thing, as if it was Elon Musk or something. Let's just put him up there and we know that more people will view this, right? And that lasted for, I don't know, was it months, weeks before then it went.
Literally, the ad I would see all the time was Sam kind of standing against a wall, and I think the sun was in his eyes, and he was kind of squinting, and the title was, this guy that's worth 20 billion plans to give it all away, or blah, blah, blah. It was so weird, right? And even the picture to me felt very deliberate, because I mean, the PR that this company used obviously was huge. And I think they really played into this character, so I don't know. It's a very odd situation, and we'll find out more as time goes on, but it's sad. And then the amount of people that are involved, right? The Mooch, Kevin O'Leary. Now Kevin O'Leary's going on a campaign himself. He was paid $15 million, and he's going on saying that, I was a paid spokesman. I've always said I'm a paid spokesman. And, certain individuals that even are, I wouldn't call them FinTwit influencers. I'd say more so YouTube influencers for finance stuff. They have come out and said they were paid for every single time they mentioned FTX. Just very odd, right? They spent so much money to get their name out there. And I guess some people could look at that as, well, they were doing it to get this widespread adoption that crypto needed or whatever, but it was just bizarre. The whole thing was bizarre. And again, like I said, it was like 20 minutes. It was here and then now it's gone, you know?
Yeah. And so that the paid people and the coverage stuff is the part that bothers me because, you know, if you write articles about something or you take pay for something and talk about it, you know that you're directing some people to that. And so you should at least check in something to make sure that it isn't, you know, totally a fraud or whatever things that it might be. It doesn't mean that if you know, do an ad for, tequila or whatever, that it has to always be your favorite tequila, that you only drink that one. But you do need to make sure that, you know, it's not harmful to people and stuff. And it is what it says it is. Right. And that's my problem with the media coverage and the people who are spokespeople for it and stuff, is that you are like directing people to that thing. And when we're talking about fraud, it's something completely different. You could advertise a product that's not very good and whatever, but if it is what it says it is, that's completely different than if you're directing people to something that actually may just be a lot of smoke and mirrors and stuff like that. And you have no basis on which to know that. But of course, all the people's argument will be, well, everyone else, I mean, and it's true. Well, I figured everyone else did the due diligence. I mean, that's the huge part about this, is when people talk to us or whatever, you know, for the most part, there isn't as much due diligence being done as people think, of the kind that's like actually very important. Buffett talks about, like, or has said sort of, you know, like price is my due diligence, and like he can make decisions very quickly and whatever. But what he means by that is like he knows the people are, or he thinks he knows that the people seem trustworthy and stuff to him. And if there's anything off about them, he's not going to do a deal with them and stuff like that. No, he doesn't know about various legal things that that the company may not have said, that actually we have this lawsuit that we haven't disclosed that because we don't think it's material, and this thing, and there's some environmental liability here that we've never disclosed because we don't think that's material, you know, whatever they could be hiding. But if he thinks that they're honest enough people and the normal sort of things are in for that, it's not going to make or break the deal, right? It's totally different when we're talking about a fraud. And so that's the kind of thing that, you know, that kind of stuff actually matters a lot to look into the people and to think about and all that. Whereas when they actually spend a lot of due diligence for some merger or something, it doesn't matter, right? I mean, Microsoft can do all the due diligence they want on Activision. It's mostly all out there, and the things, you know, they might be some stuff about the employee stuff with different sexual discrimination and other issues that they may have some of the information and not all and stuff when they made their offers. But other than that, I mean, they know everything that they need to know in terms of the size of the deal and whatever. They know what they're getting, right? When it's things like this, we have no idea, you know, and so it's completely different. So I do try to warn people about that, because I get talked a lot more than you might think about things that I go, you know, there's some problems here that I would just say, don't do it. And actually, that was something I was going to put into when I was talking about the Buffett confidence thing, because Alice Schroeder talks about how Buffett looks at catastrophic risk first. Can I lose everything? And makes that decision first. And one thing that I think Buffett talks a little bit about, but I think people misinterpret, is if you read the actual biographies and things, some stuff Buffett said, if it's his decision, right, and he is not okay with the situation with people involved or something, he smells something that does not seem right that way, he's going to not deal with that at all. Now, he's not going to talk about it or anything, but it's just not going to happen. And that's anything. I mean, I think that would be true of a charity thing or whatever. Like, just like if there's some element of stuff that he doesn't like that way in terms of the people involved or whatever, then it's over, and he's not gonna deal with comment and stuff. And the problem that I think when I talk to a lot of investors who get involved in frauds and stuff is they don't start with that. They don't start with the fact that there's a lot of red flags about this person or whatever. That's the last thing that they look at. And so they go, oh, I had all this stuff that I like about it. They found it on QuickFS or a screener or whatever. It's got all this stuff that they really like, and they don't get to that point. And then so that at that point, I've got all this upside and everything. And then I just have to decide if this is or isn't, you know? But even a small chance of that is something to be avoided. And so, you know, you can never prove that something is a fraud ahead of time, really, you know? But you can see the difference in the things that are orders of magnitude higher. You can tell the difference between this could be, I mean, let's just do that. Is this 10 times more likely to be a fraud than most things I look at? Yes. With FTX or something, we go, yes, this is, you know, compare FTX and OTC markets. Would FTX be 10 times more likely to be a fraud? Absolutely. I think there's no doubt you could say 10 times or more likely. Now, most things you see in public markets are really unlikely to be that kind of fraud. So it could be that one is a 0.2% chance, and so this is a 2% chance. But it's still a warning to you that if you're saying, oh, this is like hugely more likely, maybe I should just avoid that and avoid that throughout my entire career. Then I'll be much more successful in terms of compounding over time and stuff like Buffett does. And I think people might underestimate Buffett's skills in analyzing people almost instantly that way. And that's a really important one, that he probably crosses some things out because of the people involved.
Well said. Let's go on. What surprised you the most in 2022 in relation to financial markets, investors, business in general? Was there something that you were kind of like, wow, I did not foresee that coming, and even though I'm reading the news, I am shocked? I don't believe it's true.
I was surprised by how much the Fed raised rates and said that they would continue to raise rates and that sort of thing. I was surprised by how unconcerned people were about inflation. To some extent, people in markets and things, not necessarily the average person talking about it, but just the general belief that those things would settle down and stuff. So the kind of mix between those two. In more, broader things, you talk about the Ukraine thing. I was surprised how many people didn't think that the invasion would happen, and then how strong the response was after that, and how confrontational it was and stuff. So, which I'm sure surprised Russia too. So I just mean both of those things. I guess why I would mention those two together, the Fed thing and the inflation and the Russia and the response, is the issue there is sort of signals beforehand of it to what then they actually did wasn't very good in getting people to understand what was going to happen, right? So like in the Ukraine thing, where you take the United States and some other NATO members and stuff, if they had a way of clearly signaling to Russia exactly what they'd be doing, Russia might have been a lot less likely to invade. But they have no way to show that credibility. There's no way that Russia would say, oh, that's definitely what they're going to do. They're definitely going to, every company in the West and stuff is going to like shut down and pull out, even if they've been in here for decades. And they're going to be like people's, saying, should we let Russian teams, and people and whatever into different countries and compete in things or whatever? Should we just they basically cancel Russia, right? If they knew that kind of thing and the sanctions and all that stuff was really going to happen, then they might have thought differently. With the inflation thing and the Fed similarly, what's surprising to me about that is the Fed did not in any way signal what they were going to be doing in the year ahead. So we've talked about that it might be necessary to get to like 4% or something and to do it rather fast. Totally reasonable if I didn't know what the Fed was communicating. But based on what they were communicating, this did not seem realistic that they would do this based on their past behavior for the last 15 years or so. And, just during COVID and everything, and their communications throughout a period in which there's pretty high inflation, especially continuing to say transitory for a very long period of time. That kind of stuff really made it less likely to believe that the Fed would do what they did.
How much of that do you think was political? Because I remember distinctly last year was like, Powell was basically, we'll be slow, this is transitory, but then he was reelected to continuing being the chairman of the Federal Reserve. And then it was boom, that next meeting, it was very much like a different tone that he was communicating to the market.
The Fed avoids whether they say it or not. They avoid, doing things which are really close to the election if possible. Right. I do think to some extent they've just always expected inflation to be lower than it has been every single month. So they've always expected to come down faster and stuff. And that's part of what maybe people don't understand right now about why they put the things they did in for the dot plot in the future and everything, is that they had always expected inflation to start coming down and come down in a meaningful way. So when inflation did start coming down, that was not news to them. That's what they'd been expecting for, like, at that point, almost a year or something, that they would have expected that break in it. All the inflation predictions for like months ahead and what it will be next year and stuff from everybody, all the central banks and stuff, have been dramatically wrong. They show this huge steep drop in inflation really rapidly compared to what happened. So, so I mean, I do think that that's a big part of it, that they were convinced that it was a temporary thing. And there's a lot of people who believe that that is true now, talking about it more because they're worried about how high rates are and how much damage that can do and everything. So there's lots more people speaking out saying that they're making a mistake and stuff now, where they weren't so worried to talk about that before, because if it's transitory or not, what does it matter that much if you raise rates from 0 to 2%? It's when they're getting to these sorts of levels that people get worried and start coming out in public about it.
Mm-hmm. All right, let's shift to predictions for 2023. So 1 year from now, we could replay the tape and laugh at potentially how wrong we were. So what will be the biggest winners, do you think, in 2023 as it relates to financial markets? So either business, investors, a theme, a certain sector. What do you think will be the biggest winner in 2023?
Wow. I mean, if I knew that, then I guess we'd be invested in it.
Well, I hope so, right? I mean, I'm going to cop out here. I said value investors.
Okay.
Right? Like, I really think value is going to come back. I know that is the famous last word. I think this year was a good year for that. The rotation out of growth, the absolute slaughter of anything speculative and all that came with that. I think value is going to shine in 2023. You can book it. You could bet on it. You can invest on it. But please don't, because I'm not your financial advisor. This is not financial advice. That was kind of a joke. This is for entertainment purposes only. Value investors.
Okay. Well, I mean, I hope so, I guess. We invest into, things that I don't know if we have a strong value bet. We invest in some things that might be more quality things or whatever than the very cheapest value. But I'm not sure what will. A huge part of it in terms of predicting a year out or something is knowing things about when you will have a recession and when you will have financial conditions easing again and what the date of that will be, sort of. So when's the most likely time for that to happen? If we had to guess, sometime between like this very second, it's starting and then getting worse to a period of, halfway through the year or whatever, right? So it could be that at some point you'll see a turn in things. Things that do really badly right now or at the end of, in the beginning of next year and stuff, may at some point turn, and when we look back at it, say, actually they bottomed during the year, right? So I don't know in terms of a calendar year thing that way. This year worked, we'll see, but it seemed to have been perfect in terms of the way in which the calendar worked, so that like the exact top of things and stuff was basically like, pretty much the first day of January. Yeah. Yeah. So it makes this calendar year very convenient. Like the down 20% will look really, really bad for a calendar year when compared to other calendar years, but down 20%, from an exact one point in time to an exact other point could be more common than what this feels like, because over an entire calendar year, you had in 87, you had a huge crash. You had a stock market doing well, huge crash, then a bit of a recovery. Works out to be very nothing year, a typical year, if you do it on calendar year basis. But I think people would remember that one pretty well, right? So we'll see. But a lot of it, I think, depends on that kind of stuff. The stuff that looks really interesting in terms of just like when people ask what are the cheapest stocks that you see and stuff, the ones that like stand out as really weird, not weird because they have problems and they could continue to have problems and stuff, but that stand out as like remarkably cheap are, we've mentioned before, like Vera Bradley, which is a not successful for the last 10 years or so maker of handbags and stuff, lower priced ones and things.
That's come up on our screen.
Yeah. And the Container Store, which is like a terribly busted IPO and stuff. But if you didn't know that based on the past financials and didn't know what was coming ahead, would look incredibly cheap. I don't know if you've looked at that in terms of like the price on multiples and things, but it's insane. Have you been to a Container Store?
I have, yes.
Yeah. So I think that's a belief in something that did not, it's a basically busted IPO type thing, right? So that's like a lot of a lot of enthusiasm for something that was misplaced, I think, right? And then also some looking ahead to see, oh, well, the trends are not going to be good for, next year and stuff. But it looks like a stock without any constituency, right? Like just no one wants to buy this thing, and it's, so because if you look at the history before there, it's past record. It's a high quality, very slow growing retailer. And then it has like this, but can you do like a year chart or something so you can see what I mean?
Yeah.
Yeah. Okay. So, so just that chart like there is a good example of, year to date or 1 year or whatever. But if you go to like an all-time chart, because it's not much longer that it's been public.
It
so you
looks
can see
like
where it started.
When it went public in 2013, it was around $45 a share. And for people listening, it's currently at $4 around.
Yeah. But anyway, for the last year or whatever, it's been down a lot, and it's just very cheap and stuff that way compared to other sorts of retailers and everything. And there's not a lot in the business thing. It's kind of like when we talked about Hanes Brands and stuff. There's not a lot in the business thing that would give you an idea of why that would be. But there is if you listen to like predictions for next year or something, right? So it looks like a really niche sort of slow growing, really slow to expand business that actually is pretty high quality for what it is and everything, though it's not some amazing business or whatever that way, but it's not some amazing growth business or whatever. And obviously is priced like it's going out of business, right? It's just like for a bunch of reasons, including, like the plans that they have for the future not being things that you want to hear right now and stuff, and like whether they're realistic about it and stuff, but also just like how bad the current environment we are in is for this kind of stock and stuff like that. So there are a lot in this kind of specialty retail, consumer discretionary things that people just believe no one's going to spend on this stuff. And so that kind of stuff is getting very cheap. I mean, even into the end of this year, after Avatar came out, movie theater stocks did not do well, which is interesting because it did okay. Like it came in the bottom end of predictions probably, but it's, that kind of movie has never opened at an incredible number and stuff. But it was like that was the date for this is the one thing that could be huge or whatever, And so then people feel like, oh, well, then, nothing good is going to happen after that point, right? It was the one thing that all year people were talking about, well, this could be huge. You don't know how big it could be. We have no idea, So those things, which I also think is in part like not high expectations for next year. People are just very pessimistic about that, We don't talk about this on this podcast, but consumer sentiment surveys and stuff are terrible. Like if you ask people what is really happening with you or businesses, it's like, it's pretty good. It's certainly within normal stuff. But if you ask them, like, do you expect to be better off in a year, like worse? How do you feel? How are things? It's bad. If you just take the confidence part of it, our right track, wrong track sort of thing for your business, for your household, whatever, it's all wrong track. It's going to be worse next year than before. This feels like a recession to me, So I think a lot of it in terms of the stock market and stuff will depend on that. And then whether there's a pivot in terms of monetary policy and stuff, because, that wouldn't be surprised if those things coincide on terms of the stock market, because the stock market can easily bottom pretty much in the middle of, that's like at, we may not have said this was a recession start on such and such date by the time that's actually the date we say this is the stock market bottom. Yeah.
Mm-hmm. So we could take the other side of that. What will be the biggest loser in 2023? And before you answer that, to give you a few seconds, I will share what I think will be the biggest loser. And I think it's going to be the expectations of retail investors. And I've said this a few times on the podcast, that I think the markets that we had over the past, 3 or 4 years, where people are just investing like drunken sailors, just zero interest rate policy, stocks to the moon, unlimited amount of, speculation. I believe those days are done. And I think the biggest loser in 2023 will be the retail investor that thinks if inflation ends up being transitory or the Fed really breaks something and, comes off on interest rates a little bit, or maybe they change how they think about inflation, whatever. Basically, if interest rates come down, I think the consensus is going to be that it's back to, partying like a rock star, like how it was before. And I think those days are just done. So I think the biggest loser in 2023 will be the expectation of retail and growth investors.
Yeah, that might be. I don't see a lot of stuff that seems incredibly overvalued and ready to, decline by a lot. So there's some things that might not do well. But not like coming into this year, there was much more stuff that we say this is radically overvalued and set up for bad things about to happen for some of them. There's some things that are incredibly expensive, but I don't see them like, they're high quality and stuff as compared to what we had before. So I'm not sure. I think, probably, like I've been saying for a while, I think like the online versus offline, I think we've got lots more information on that online's not doing well. We've seen it in like just discrepancies in terms of like how sales are doing and as like deliveries and shipping and stuff. I don't think we'll see like a great Christmas season and stuff for online things versus offline. When I was in malls and stuff, offline, I think is probably relative to last year doing better versus online than last year was. So I think that that's something, but the question with that is some of these things have dropped a lot already. Now, if you're down 65%, people won't really remember in the history books that you dropped another 65% because it doesn't add a lot more to the decline. When you say to people the S&P, the Dow or whatever dropped 80 to 90% in the Great Depression, that just, it sounds like a number or whatever, but you have to remember after it's down 70%, a really big drop from there doesn't add a whole lot, it doesn't add a whole lot more to that number. So we'll see, but I'd say, those sorts of things, those online sorts of things versus offline are probably the one that would be the biggest question for me. But some of them are down a bunch and some of them are really good companies, so that's the, even like we've talked about Meta and stuff, things could be really bad and the stock could do okay because it's priced in stuff that it's never priced in its history. Amazon's not a cheap stock, but it has repriced a lot versus what it was. So I don't know which ones there would be in that would necessarily do that badly with having poor kind of business results. But I do think there will be some change in terms of what people like what has good earnings growth next year versus what people have been used to. We already saw that this year where people were like excluding certain things, like here's earnings growth excluding, and we just throw energy out and stuff, as a category that doesn't count. We have to show you the other ones, and
Yeah.
So yeah, and then obviously there's been a big change in market cap stuff relative, right? Because like going into the year, whatever, energy would have been like no percentage of anyone's, indexes and stuff, and information technology or whatever they call it would be huge. Now there's been a big change in that. So yeah, I don't know exactly. Some land things and stuff like that are really expensive. And so some companies in that are maybe not so great futures for them. I think some of that might be more overpriced than anything else I can think of. Is like real estate, especially in the other English speaking and some other economies that aren't the US. Not that it'll be good for the US, but some of those are really expensive. And so some companies people bring me from those are the most overpriced, most in danger of like having really bad results at the same time as coming into it really overpriced. Is anything exposed to residential real estate prices and things like that in, like I said, other English speaking countries and stuff. So, UK, Australia, New Zealand, Canada, more so than the US. But that, the U.S. home builders I've seen, they're kind of like priced more, not like they're about to be going out of business or anything, but they're priced cheaper than they had been the last few years, right? Even something like Green Brick Partners, which I think is like the most premium priced of those sorts of things, probably. There's a few others that might be as much as that are barely above book, right? They're at book. Okay.
Mm-hmm.
And then the really big ones seem to be a bit below book. So it's hard to say. I don't see good things in the future for companies like that because, you might think the business results will drop off a lot, but that doesn't mean that the stock results will, because getting in at 1x book or something is a big help, right?
Mm-hmm.
So
very true.
Yeah. But you think it will be a good year for value?
I do think it'll be a good year for value.
Mm-hmm.
I do. And I do think that there has been a sea change, to quote Howard Marks. And I think it'll be a great time for stock pickers. I really do. For people that aren't just investing on autopilot and are thoughtful about it. I mean, where we currently sit now, I like to kind of understand where we're at, right? Mm-hmm. To try to get an idea of where we're going, especially since so much of the markets is about the future and expectations and jazz like that. But so the bullish expectation for the S&P 500 next year is to earn about $220 a share, right? That's the ambitious target. And that is a 2023 EPS. And where we currently are trading right now, it's about 17 times is where we're at. So I don't know. I mean, rates have gone from 0 to, 4.25, 4.5. Inflation is not really rolling off a lot. They're taking liquidity out from the system, and the market is kind of trading at 17 times 2023 earnings. I could see how we could come down a lot more from where we currently are today.
Yeah. So, well, I mean, look, in terms of price, it's expensive. The market's really expensive in terms of price overall, but I've said that for a lot of my career, right? So it's, but I mean, the disconnect in terms of price versus interest rates and things is incredible. This is only back to like .com type stuff. Even it was a little more mild, the pricing and stuff around the financial crisis. So we're talking about during my career, certainly the only times are .com, the bubble, and right at the moment, the financial crisis, that you ever had things where interest rates were at levels that were pretty reasonable in terms of you could get a return in bonds and things, and yet stock prices were pretty expensive. And so your Schiller P's and things like that, they seem really, really expensive. So on the other hand, 2 consecutive years of pretty similar sorts of things are, really uncommon. I can only think of like the thing like we've seen this year continuing at this pace and stuff for a whole nother year is mostly something you see in like the 30s and the 70s. They had a period where it happened for about that. Most other things, don't work quite that way. In that either things happen pretty rapidly, you have some pretty huge declines, instead of like it being sustained over such a long period of time. So it, usually betting that if you just had a bad year for the market or something, you'd bet positive things. But, I did research as best I could on like normalized PE things and stuff. And there is a huge, huge effect that simply buying in low priced years, versus high priced is a lot better. That doesn't mean that some decades, even the high priced years do okay, but still you're better off buying in the low priced years, and so that is something that, it's just very uncommon for people to experience a period that goes for that long. And that is something that we'll see, because that will really change, like what you were saying about these things, if it changes the attitudes of retail investors going forward and stuff like that, and people's attitudes towards risk and stuff, that sea change, that's really from a length of time, I feel, and not a huge drop. People always think that this like gigantic drop, this COVID drop, or this financial panic or whatever is like what does it. But usually you'd be surprised how quickly people get over a panic, because then they're like, well, we know what that was. It's over now. It's not going to happen again. There's not going to be
guys ahead,
right? Like whatever, like bad things will happen. But if we just went through a horrible bank crisis, it won't be another horrible bank crisis. And that's all that people are looking out for, right? And if it's a horrible pandemic, it's not going to be the next thing that happens won't be a terrible pandemic. So it's the like constant declining down. And the only time that I can think of that people like that are probably listening to this, unless they're quite a bit older, remember is after the .com. Because
yeah, it's like 01, 02, right?
Right. It's the 02 and stuff that like what people, the crashing of it and whatever is okay. But it's the point at which you just got sick of things. Like we talk about, like, or a couple different companies, when Domino's went public, when those things, like, how could that have been and whatever. It's because that's only a few years after people are just like sick of any of that kind of stuff. They were not into IPOs. Like the best IPOs, right, came out a few years after that, where no one was into that. Whereas the worst IPOs, of course, come out in the middle of like some growth market. And so in the early 2000s, people were like, I don't want anything to do with all that growth stuff. I don't believe in that stuff anymore and whatever. And we're really down on the stock market. But it's not like it happens instantaneously. It was just a really bad year. It's when you buy the dip or whatever, and then you lose more money, and then you do it the next year and you lose more, and you do it like 3 times, something, then you go, that's it. It's not just like
my screen.
Well, we had the experience with the starting our fund, right? We basically started our fund and COVID happened like the same time. I mean, we started January of 2020. So COVID was basically circulating from like the moment we started, and the world shut down within like 90 days of us starting or something. So that all happened fast, right? But did the return to normal, people wanting to put money into stuff with us, the way people were thinking about investing stuff, also happen fast?
I would say it happened pretty quickly. Yeah.
Yeah. I mean, in April or whatever, let's say shortly after everything's bottomed and whatever, I don't think we would have said, in a very short period of time, people's attitudes will be a lot more like they were in January when we were starting up.
Yeah. Mm-hmm. No, that was surprising to both of us.
The world was incredibly changed. The economy was incredibly changed. Inflation. I mean, every real thing was changed. People's lives were changed incredibly, right? But attitudes about things changed fast. Now, here's the thing. I would say people's attitudes living through this whole last year have been affected in many ways as much as what they were in COVID in terms of financial things, because the market went down, right? And like it didn't keep going down at the same pace. But for a lot of people in their portfolios, it really didn't get better for very long during the year. They might have been flat sometimes, but they were not feeling like they were getting back towards where they had started the year. And so it was a grind for them throughout the year. Mm-hmm. And I think that has maybe changed some people's attitudes and interest rates and stuff like that too. But I just think you're right in that whatever happened during COVID did not feel like a sea change in people's attitudes. In some ways, some of it felt reminiscent of other stuff that had happened with the Fed before and with stock markets before, since the financial crisis, which is that when something like this happens, it's bad. It happens for a short period of time and it's really bad and whatever. But even if the real economy doesn't get back on its feet that fast, the stock market starts going up, rates will go to zero, and there'll be emergency stuff, and stocks will start going up immediately, right? And like you're used to a decade of stocks really doing pretty remarkably well considering what the underlying economy was like and everything. And I feel like that coming out of COVID, people readjusted back to that thinking fast. I feel like people's financial lives went right back to where they were much faster than their real lives.
Mm-hmm. I mean, which is that a testament to the Fed basically flooding the system with liquidity so people felt comfortable to keep the movement of money going?
Yeah, well, here's the interesting thing, right? Yes and no. So yes, they got it back on trend. But then given what happened with inflation, it turns out that it shouldn't have been put back on trend. Mm-hmm. That in essence, labor didn't come back on trend and everything. There were actual things in terms of supply, right? That didn't get back. And so this isn't a precise science and stuff, but basically they put a demand back on track as if the economy could bounce back right away. And of course, then there's a disconnect between Fed policy and fiscal policy and regulations and restrictions, right? And that's happened in a few countries now where, okay, let's do it like we'll be right back to where we were before. But then every other aspect of your life is not back to where it was before. And so we saw weird things like huge responses in financial things and huge responses in online stuff. And yet not as big in other things, right? So it's like the thing I compare it to always is like World War II, where everyone in the United States who was still in the country and stuff was employed and had making lots of income and all that, but they were severely restricted in spending because there was a housing shortage and stuff. They couldn't go out and buy housing and stuff because they weren't building that. They couldn't, literally the companies that were building cars and washing machines and all the things that they had been buying to spend all their money before the war was literally not happening anymore, right? So that's why that to this day is the biggest ever for like movies. People were literally going out to movies and to entertaining and to all that kind of stuff because they had a lot of money to burn and they literally were shut off for being able to spend it some places. You couldn't go to restaurants, and people wouldn't go to like theme parks and places and around the world and stuff where you were worried that restrictions might change or travel might change from the time you make your plan to then. So that's the thing that's really interesting, because like these things with these online stuff, right, is some of them kind of believed, oh, this is like this. In fact, there was lots of articles. This accelerated the trend. So like we're on a different trajectory now, but this was always going to happen. But this is an acceleration, like as if, online shopping or something is not like heroin or something. The fact that you exposed a few more people to it doesn't mean that, they're all now habitual users of it and they're not going to want to go back and do things in person in life, So it may have pulled things forward a lot, which is what probably did happen. But that means that just like when you pull demand forward for cars or for houses or whatever, things revert back. And that's why I still think, looking at the economy stuff, the thing that I still think there's room for a shift that might surprise people in terms of real offline economy stuff versus online economy stuff. And definitely on the business spending side and stuff. That's the one that, like, I don't know if I could predict the stock market things, but the one I will stress is if you're selling to Google or Meta or whatever, I don't know how those particular stocks will do, depend on the advertising thing and all that. But if you depend on providing services and goods and things to them, they're your customer, it will not be a good year for you, because that's where we're going to see and are seeing, I think, real signs of a serious slowdown in terms of their spending and cuts and things in those tech related things that have been very free spenders for the last 10 years. They may even, they're going to respond with a very different approach to all that in terms of their business. They're going to run their business differently. They're going to be a lot more lean on that and press people on that. So, I just think that kind of thing, will be really different. A lot of the other things, it's harder to predict. Like when, people ask about restaurant things or whatever, because it's a supply demand thing. There's still things where I don't know. I mean, I think this demand will be there for some stuff, but your margins may not be any better. And I know people don't believe that, but so here's the thing. The margin compression, right, and the earnings decline in a recession is like always worse than analysts predict. Okay. So even when they predict the recession, no one ever there's someone out there, some outlier who predicts it, but the consensus prediction for what will happen in a recession is always less than actually happens. So like unemployment rises by more than the consensus predicts it would in a recession. Your model says this will be up in this recession. The one that's next about to happen, you're always wrong. Even if your model's right on average, normally you tweak it so that, it says it's not going to be as bad for this one because you have other reasons why you think it won't be. So margins and stuff normally bottom out like in the actual recession. So your costs, which we've seen, went up, but now you can price it so that it's okay. Well, it seems like, okay, your inflation coming down is really great for the market and everything. It's not so great for a company if economic stuff is slowing down and your costs have been going up. That demand comes down now because a bunch of them have much higher costs in inventory, different companies, and their stocks have done okay in some cases because demand has been there. But when demand's really strong, it's easy to have really good numbers. You don't have to be that efficient and stuff. Where the cost stuff hurts you is the next time that we see poor demand, which for some industries won't coincide with the recession. It could be other stuff, but for lots of industries will coincide with a recession. So that's the unfortunate thing, when we talk about these entertainment things, Disney and whatever stuff. Yeah, your parks and things will look great when there's a lot of demand for it. But the next time that demand isn't so good, then we'll see what were the results of not having enough labor, not having enough, if your costs went up, we'll see that more the next time that demand goes down.
Got it. Cool. Well, that was a great explanation and I think a great place to stop, Geoff. I thought this podcast had the potential to be a 20-minute podcast. So I had a bunch of follow-up questions, but here we are over 2 hours, and I think it's a great place to wrap up 2022, and we will pull our predictions out next year. And I think it would be fun to do this indefinitely as long as we are still doing the podcast and see what our thoughts were on the previous year and the predictions for the future, when we get to hold ourselves accountable, which will be a lot of fun, especially when people are tweeting my wrong predictions at me. So I want to thank everybody so much for tuning in with Geoff and myself. If this is the first time you're joining us, we have almost 5 years. In February, we will come up on 5 years of recording and producing and putting out the Focused Compounding podcast. I don't think when I started that either of us really thought that we'd be doing this for almost 5 years, but here we are. So having a lot of fun doing it. And the thing that makes it most fun is that individuals actually listen to it. It's not just the both of us talking to the microphone, but I do think we both started the podcast not really caring if people listen or didn't listen. It was just topics that we were excited to talk about on the podcast. So I'll thank everybody so much for their support over the years. Pretty crazy 5 years coming up on it. But I want to wish everybody a very happy holiday season. If you already celebrated a couple holidays, hope that went well. But this is the final podcast to wrap up 2022, and we will see you all next week, per usual, where we will be discussing financial topics. So I want to thank everybody so much for tuning in with Geoff and myself, and we will see you in 2023. Isn't that the most annoying pun? They're like, oh, see you next year, and it's like next week. So I want to thank everybody so much for the support. Enjoy the holiday, enjoy New Year's, and we'll be back at it next week. Take care.